Okay, so far we have used the ADAS model to explain the short-run economic fluctuations in the economy. So Keynesian economists focus on the demand side and believe in sticky prices, especially, the input prices are sticky downward. So we are looking a little closer in this chapter. This is appendix to chapter 14. A little closer to this Keynesian model. So the aggregate expenditures model, this is what we call aggregate expenditures model, which is an extension of the Keynesian perspectives. So this is how, Keynes developed his theory. Okay, so on the demand side, right? Here, what we're going to be doing in this chapter, first of all, we will be looking at the income and consumption relationship, and then it will be income and saving relationship that we would like to put it together. So don't forget the Y stands for GDP and also the income, right? If there is no taxes involved, this can be split into between the consumption expenditures and savings. Okay, so basically, the answer to this, the first question that we're focusing on is to be clear that the greater the income, the greater the consumption. The greater the income, the greater the saving as well. But consumption and saving has some sort of a trade-off, right? So we'll come back to that. And then we'll be looking at somewhat investment and the interest rate. IR stand for interest rate and I for investment. Then we will develop a very important concept. It's called a multiplier. And this concept of multiplier relating changes in spending, okay? Changes in spending. How the spending that we change affect the output, okay? So the spending in this case is the aggregate expenditures. And you already know this is on the demand side. We are deriving the aggregate demand. So the aggregate expenditure is the aggregate demand, which is the sum of consumption expenditures, government investment, government expenditure, and net exports. Okay, so we will be looking at interest rate and investment as well. Oops, sorry. And once we get the concept multiplier, then we'll be looking at how this demand side determined the GDP, right? How aggregate expenditure determined the GDP, which we already know aggregate demand will determine the GDP. All right, so one more time, the components of the aggregate expenditure is the consumption expenditure, investment, and government spending, and net export, right? Those are the items combined to be aggregate expenditures. All right, so now let's take a look at those three variables, right? Income, consumption, and savings. Income, consumption, and saving. So consumption and saving are primarily determined by disposable income. Okay, disposable income. Right, so DI stands for disposable income, right, which means the GDP minus taxes. Okay, if we have, assuming the lump sum tax, income minus taxes will be disposable income. So both consumption and saving have a direct relationship with the DI, okay, which means the consumption and saving will go up as disposable income rises. Again, if income rises, consumption will go up. If income rises, saving will go up. Okay, so what we're going to do next, we'll be looking at the planned household spending. How much household plan to spend, right? So depending on how much money they have. So what I want to show you next is this red line. This is a 45-degree line. The red line here is a 45-degree line, which represents when the two variables here equals the variable here. So the variable on this horizontal axis is the disposable income, y minus t. Let me call this a bit differently. Sometimes I just call this di, okay, di, or your book might call this yd, disposable income. And on this end, it depends. This is already expenditure. But right now we're looking at just a C, consumption expenditure. So the consumption expenditures, depending on how much money you make, right? So the red line or becomes a pink line now is when we look at this consumption and then we see, okay, if income and consumption equals, then we don't have any saving at all. So basically, the disposable income equals C plus S. Now, if you make 6,000, right? If it's a 6,000, and in order to have the income of 6,000, it should show us right here. And expenditure is 6,000. But the fact that the green line is not at 6,000, is at 97, which is a year, by the way. So that representing that we have a little bit of saving, okay? Because the green line is basically your consumption line. It might not be the same as the income all the time, right? In this case, right here, we have a little bit of a saving. Okay, that was how they related to one another. Okay, so the consumption schedule looks like this. So consumption schedule is a function of the income. Okay, so basically you're going to see something like A plus B times YD. And we will do this in a minute. All right, so on the next page, we are going to plot those two curves together, okay? So this one is going to be on the horizontal axis. This is disposable income. And on the vertical axis, we're talking about consumption and saving on two separate graphs. All right, so if we look at the data that we were talking about earlier, we'll see something that looks like the following. For example, if this individual has an income of, let's see, how much, I'm trying to use a number that we have here. All right, so with an income of $390, okay, with an income of $390, okay, so if this is a consumption expenditure equation, possible income, so that means at the income of whatever this is, it could be $390. If income is $390, then consumption and income exactly the same, so saving is 0. And for every dollar that you earn, you're going to spend on consumption, but not all of them will be on consumption. Some of them will be saved. So basically, the slope of this consumption curve, let's see, it could be in the form of like this. In this case, let's see 300 plus 0.8 YD, which means for every extra dollar you earn, you're going to spend 80% of it. 20% will be saved. So right here is break even. You don't owe any money to anybody, and you don't save anything. But right here, when the consumption is larger than the income, for example, if this is 300, let's say that 320, right? 320. But you make an income of, let's say, 300. So at the income of 300, you should consume only 300, but you need more. You actually consume 320. So that would be the D saving right here. 300, that is lower than before, and the slope is going to look something like this. Okay, a little bit different slope. So the slope here is 0.8. So the saving equation is going to look something like that. If this is 0.8, then this will be 0.2. Alright, so that is what we call the marginal propensity to consume. Okay, but before we get to marginal propensity to consume, let's take a look at the average propensity to consume, the APC. What is this? This is the fraction of the total income consumed, the spent on consumption. So then the term average propensity to save then means fraction as well. Fraction of total income saved. Alright, so formula-wise, very straightforward. APC plus APS should not be above what we can make, right? So APC is a fraction. So APC then equals to the total consumption divided by the total income. You can put it this like a Y. It's okay. So the total income. And the APS is the same token. APS is saving divided by income. Okay, so the fact is here that APC plus APS equal to 1. Of course, the average cannot go over the total amount, right? When you divide it by the total amount of income, that scales it down to 1. Okay, so I think I'm going to stop right there before we continue on the next slide with the marginal propensity to save and everything.